Maritime Academy. Law of Marine Insurance, Part 1. Chapter 1. Contract of Indemnity. The basis of a contract of marine insurance is contained in the opening section of the Marine Insurance Act 1906, which reads as follows. A contract of marine insurance is a contract whereby the insurer undertakes to indemnify the assured in manner and to the extent thereby agreed against marine losses, that is to say, the losses incident to marine adventure. Many of the main legal principles, for example, the rules relating to insurable interest, gaming and wagering policies, excessive overvaluation, double insurance, contribution, and return of premium abandonment, and right of subrogation, and the merger of losses all spring from this concept. Not a perfect contract of indemnity. A contract of marine insurance, though a contract of indemnity, is by no means a perfect contract of indemnity. As in all walks of life, there is always a margin of error. In some instances, the theory may more than indemnify the assured for his loss, and in others, he may be under-indemnified. That the principle is not infallible was noted by Lord Sumner in British and Foreign Insurance, Co. Ltd. v. Wilson Shipping Co. Ltd., where he said, "In practice, contracts of insurance by no means always result in a complete indemnity, but indemnity is always the basis of the contract." In similar terms, Mr. Justice Pattison in Irving v. Manning, who also resigned to the fact that perfection may be difficult, if not impossible to achieve, openly declared that a policy of assurance is not a perfect contract of indemnity. He acknowledged the fact that it has to be taken with qualifications, one of which is the effects of a valued policy, the problem he was asked to resolve. In a valued policy, the agreed total value is conclusive. The parties have conclusively admitted that this fixed sum shall be that which the assured is entitled to receive in event of a loss. Gaming and wagering contracts. There are essentially two broad types of gaming or wagering contracts identified by the Act. The first relates to contracts where the assured has no insurable interest or expectation of acquiring such an interest, and the second to policies which declare that the policy itself is proof of interest, commonly referred to as honor policies. No insurable interest or expectation of acquiring such an interest. As was seen, the very essence of a contract of marine insurance is that of indemnity. This necessarily means that an assured who has no insurable interest in the subject matter insured, in the sense as defined in Section 5.2, would not be able to show that he has suffered a loss. In the words of S.5.2, he is not prejudiced by its loss or by damage thereto, or by the detention thereof. Such a contract, where the assured has not an insurable interest as defined by the Act, is deemed to be a gaming or wagering contract, and therefore void by Section 4.1. Where the policy is void, the general rule is that the assured is by Section 84.3a entitled to a return of premium. But as such a contract is forbidden, the premium is not refundable by reason of illegality, a defense specifically laid down in the said section. There are two parts to Section 4.2a. The first refers to the case discussed above, where the assured has not an insurable interest, and the second to where the contract is entered into with no expectation of acquiring such an interest. The corollary of the latter is that if the assured has a genuine expectation of acquiring an interest, then the policy is not a wager policy. Naturally, this has to be read with Section 6.1, where it is laid down that the crucial moment when the assured must have an insurable interest in the subject matter insured is at the time of the loss. He need not be interested when the insurance is affected. Honor policy. Section 4.2b states, a contract of marine insurance is deemed to be a gaming or wagering contract. Where the policy is made interest or no interest or without further proof of interest than the policy itself, or without benefit of salvage to the insurer, or subject to any other like term, provided that, where there is no possibility of salvage, a policy may be effected without benefit of salvage to the insurer. It is to be noted that such a policy does not automatically rule out the possibility of the assured having, in fact, an insurable interest. The fact that the wording of the policy dispenses with proof of interest does not necessarily mean that the assured does not or cannot have an interest in the subject matter insured. Though void in law, such policies are not illegal. Thus, the assured is entitled to a return of premium if he is able to prove that he has in fact an insurable interest in the subject matter insured. Double insurance, contribution, and return of premium. The legal rules on double insurance and the return of premium, therefore, and contribution all emanate from the principle of indemnity, that the assured is entitled only to indemnity and not profit. Just as the assured is not allowed to profit from a marine policy, the same applies to the insurer, who is not allowed to retain the premium for a policy where he runs no risk, or where the subject matter insured is not exposed to maritime perils. Double insurance. Overinsurance by double insurance occurs when two or more policies are affected by or on behalf of the assured on the same adventure and interest or any part thereof, and the sums insured exceed the indemnity allowed by the Act. The same assured is insuring the same subject matter for the same adventure, for the same interest, and for the same perils. There is no double insurance where one or more of these subjects are different, or where one of the policies is, for whatever reason, unenforceable. As two or more policies with different insurers are in operation, the assured is permitted by Section 32(2)A to claim payment from the insurers in such order as he may think fit, provided that he is not entitled to receive any sum in excess of the indemnity allowed by the Act. Should he receive more than full indemnity under either policy, valued or unvalued, he must give credit for the sum in excess of the indemnity, and is deemed to hold such sum in trust for the insurers according to their right of contribution among themselves. Double insurance on a ship is said to be extremely rare, but occasionally arises, inadvertently rather than intentionally, in practice in respect of insurance of cargo. In this regard, it has to be said that increased value policies, common in cargo insurance, do not give rise to double insurance. This is because the subject matter under such a policy is not on the goods themselves, but the increased value thereof. Contribution. In the event of overinsurance by double insurance, fairness has also to be observed amongst the insurers. Each insurer should not have to contribute more than his proportion of the loss. Section 80 spells out the rules as to how the matter is to be resolved amongst the insurers inter se. The fundamental rule is that he should not incur more than the amount which he is liable under his contract. Return a premium. An insurer is not liable for more than his share of the risk. The corollary of this is that an assured who has overinsured by double insurance would be able to recover a proportionate part of the several premiums which he has paid to the various insurers. The right to demand a return of premium in such a case is, however, subject to the proviso in Section 84(3)(ef) that a premium is not returnable if the polices are affected at different times and an earlier policy has at any time borne the entire risk. A claim has been paid on one policy in respect of the full sum insured thereby. The double insurance is affected knowingly by the assured. An assured who deliberately overinsures by double insurance may well be found guilty of a breach of the duty of utmost good faith, Section 17, and of disclosure, Section 18. Subrogation. There is no doubt that the right of subrogation is a necessary incident of a contract of indemnity. In the words of Lord Justice Brett in Castellian v. Preston, subrogation is a corollary of the great principal law of indemnity, and it is from this principle that an assured is not permitted to recover more than his actual loss. In the Act, the law relating to subrogation is contained in Section 79, which is divided into two subsections. Subsection 79(1) refers to subrogation in the event of a total loss, and subsection 79(2) a partial loss. On settlement of a loss, the indemnifier, the insurer, is, by the rule of subrogation, entitled to step into the shoes of the assured. Having paid the assured for the loss, he is subrogated to all the rights and remedies of the assured in and in respect of that subject matter as from the time of the casualty causing the loss. The objective of this process is to prevent the assured from taking with both hands. Once indemnified, he would not be allowed to be compensated twice over for the same loss. By way of subrogation, the insurer has to sue in the name of the assured, whereas in the case of an assignment, he may sue in his own name. It is to be noted that there is no right of subrogation in respect of an honor policy. Void in law, the policy is not only unenforceable, but no rights can be derived from it. Settlement of total loss. In the event of a settlement of a total loss, the insurer is by Section 79(1) entitled to take over the interest of the assured in whatever may remain of the subject matter so paid for, subrogated to all the rights and remedies of the assured in and in respect of that subject matter, as from the time of the casualty causing the loss. There are two separate aspects to this rule: the right to take over the interest in the remains of the subject matter insured, involving abandonment and proprietary rights, and the right to subrogation. Though distinct, both rights are kindred to the principle of indemnity. In respect of abandonment, the rights exist on a valid abandonment, whereas in respect of subrogation, they only arise on payment. Abandonment and proprietary rights. The word entitled, appearing in Section 79.1, clarifies that the insurer is not compelled to take over whatever may remain of the subject matter insured. The effect of this rule has raised interesting questions relating to proprietary rights over the abandoned property. This provision has to be read with Section 63 on the effects of abandonment, stating that where there is a valid abandonment, the insurer is entitled to take over the interest of the assured in whatever may remain of the subject matter insured and all proprietary rights incidental thereto. Acceptance of abandonment. In practice, insurers rarely accept the abandonment, for this carries with it not only rights but also liabilities in respect of the abandoned property. Obvious liabilities are expenses incurred for the removal of the wreck and damage caused by oil pollution. However, should they agree, whether expressly or impliedly, to assume ownership over the remains of the subject matter insured, they would be able to retain any profit made on its sale. It is observed that in the case of abandonment, the insurer is entitled, although not bound, to take over if he does the whole interest of the assured in the subject matter insured is transferred to him. In this regard, some may say that the principle of indemnity has failed to realize its full potential, that the contract is not one of perfect indemnity. In accepting the abandonment, the insurer takes over not only rights but also liabilities in relation to the remains of the subject matter insured. Thus, it could be validly argued that as he had assumed all responsibility in respect of the subject matter insured, he should be allowed to keep any reward arising therefrom, which may be regarded as the consideration or price for accepting the good with the bad with the transfer of ownership. The same rule applies to the case of a missing ship. The insurer, on paying out, is entitled to keep the vessel should she later reappear. The insurer is also, by reason of Section 63(2), entitled to any freight earned after his acceptance of the abandonment. The right to receive payment of freight accruing due but not earned at the time of the disaster is one of those rights so incident to the property in the ship, and it therefore passes to the underwriters because the ship has become their property. To negate the operation of Section 63(2), the Freight Waiver Clause, Clause 20 ITCH 95, and Clause 18 IVCH 95, states, in the event of total or constructive total loss, no claim to be made by the underwriters for freight, whether notice of abandonment has been given or not. No acceptance of abandonment. Problematic issues, however, arise where the insurer does not exercise the right to take over the interest of the assured in whatever may remain of the subject matter insured so paid for. The pertinent question is, who is the owner of the abandoned property? There are three possibilities as regards the subject of ownership on abandonment pursuant to a total loss. Ownership could be automatically transferred to the insurer on settlement of the loss. The abandoned property could be res nullius, belongs to no one, or all proprietary rights remain with the shipowner. Automatic transfer of ownership to insurer. In Simpson versus Thompson, decided before the Act, Lord Blackburn of the House of Lords advocated the notion of automatic transfer. He had no doubt at all that, where the owners of an insured ship have claimed or been paid for a total loss, the property and what remains of the ship, and all rights incident to the property, are transferred to the underwriters as from the time of the disaster. He argued that the validity of the rule as regards the insurer's right to freight, now contained in Section 63(2), can only be supported if this was the case. The wording of Section 63(2) does not say anything about transfer of ownership. It is capable of two interpretations, namely that the insurer is entitled to the said freight only if he accepts the abandonment, or regardless of whether or not he accepts the abandonment, unless the insurer has exercised the right to take over the interest or the notion of automatic transfer of ownership applies. It is difficult to see how he could be entitled to the freight earned subsequent to the casualty causing the loss. Lord Blackburn obviously prefers the latter construction. Res nullius. Mr. Justice Bailhache in Mayor and Corporation of Boston versus France, Finnick and Company Limited expressed the view that the wreck must be res nullius, meaning in lay terms that it belongs to nobody but to the world at large. Both the above rule of automatic transfer of ownership and of res nullius are regarded by many as difficult to support, not only on the ground of the wording of both Section 63 and 79, but also of Section 61, where an assured may, in the event of a constructive total loss, treat the loss as a partial loss. If the assured was held to have been divested of ownership of the remains, it would be impossible for him to treat the loss as a partial loss. Ownership remains with the assured. The third view, held by Lord Justice Greer in Oceanic Steam Navigation Co. v. Evans, is that if the abandonment is not accepted by the insurer, the owner, assured, is not divested of ownership of the wreck. In other words, there is no automatic transfer of ownership, and the property is not res nullius but remains in the ownership of the assured until such time as the insurer exercises his right to take over control or ownership over the abandoned property. This appears to be the preponderant view. Rights of subrogation. The second part of Section 79.1 confers upon the insurer all the rights and remedies of the assured in and in respect of that subject matter. In this regard, the extent of the subrogative rights has to be considered in relation to recovery of damages from a wrongdoer gifts and voluntary payments received by the assured and the right to salvage in the case of underinsurance. Recovery of damages from a wrongdoer. In the event of a collision for which a third party is liable, an assured may well receive by way of damages an amount in excess of what he is entitled to claim under the policy. It is also possible that the insurer himself may, after having indemnified the assured for his loss by exercising his right of subrogation, recover from the wrongdoer a sum in excess of what he has paid to the assured. The crux of the matter is which party, the assured or insurer, is entitled to keep the excess. It should not make any difference to the question of entitlement to the sum already paid by the insurer to the assured and to the excess, whether the assured or the insurer has recovered the damages from the third party. Recovery of the amount paid by the insurer. In the early case of North of England Steamship Insurance Association versus Armstrong, the insurer paid the assured the sum of £6,000, the full sum insured, as for a total loss when the insured vessel was run down and sunk by another ship. Subsequently, a sum of £5,000 was recovered against the owners of the other vessel. The real value of the insured vessel was £9,000. The insurers asserted that they were entitled to the whole of £5,000. Chief Justice Cockburn awarded judgment in favor of the insurers on two grounds. First, by reason of the conclusive nature of a valued policy, and secondly, on the point of law relating to the right to salvage pursuant to payment for a total loss. Using the right to salvage as analogy, Chief Justice Cockburn has implied that the insurer would be entitled to the whole sum, including the excess, in the event of a settlement with the assured. He was only able to arrive at this decision on the ground of automatic transfer of ownership. It has to be said, and with due respect, that he has failed to appreciate the distinction between the right of the insurer to take over the interest of the assured in whatever may remain of the subject matter insured with all proprietary rights incidental thereto, and the right of subrogation. Insofar as the sum recovered from the wrongdoer did not exceed the amount which the insurer had paid to the assured, the decision of the court is correct. But real problems, however, would arise if the recovery was to exceed the amount paid out by the insurer. In Thames and Mersey Marine Insurance Co. versus British and Chilean Steamship Co., the Court of Appeal, on similar facts, also held that the insurer was entitled to the whole sum recovered by the assured from the wrongdoer. But again, as the amount so recovered was not in excess of the sum paid out by the insurer, the decision cannot be faulted. However, insofar as the amount of damages recovered was calculated on the basis of a figure, the real value of the ship, higher than the agreed value stated in the policy, the decision is open to criticism. Recovery of the excess. As was seen, there was no excess in either of the above two cases. Thus, they cannot be cited as authority for having laid down the rule that an insurer is entitled to any excess which may be recovered from a wrongdoer. The case which is directly on point as regards such a claim is Yorkshire Insurance Co. Ltd. versus Nisbet Shipping Co. Ltd., where the insurer had, in accordance with the terms of the policy, paid the assured £72,000 for a total loss. Subsequently, the assured, because of a devaluation of the pound received from the third party, liable for the collision, a sum in excess of what they had received from the insurer. The insurers then proceeded against the assured, claiming not only what they paid out, but the whole sum which the assured had received from the third party. There was no doubt whatsoever that the insurer was entitled to recover the sum which he had paid out to the assured under the policy. By the doctrine of subrogation, they were clearly entitled to at least £72,000. But whether this right to subrogation extends to recovery of the excess was the main ground of contention. The court held that the insurers were entitled to be paid only the amount which they had paid under the policy. The excess windfall belonged to the assured. According to Mr. Justice Diplock, the law has never suggested that the insurer can recover from the assured the amount of the excess. More pointedly, his interpretation of the second part of Section 79(1) was that it was limited to recovering any sum which he has overpaid. He cannot recover more than he has in fact paid. The rule that the insurer is entitled only to what he has in fact paid out under the policy is derived from the principle of indemnity as spelt out in Section 1 of the Act. In this context, the words "in the manner and to the extent thereby agreed" are particularly relevant. For the same reason, if the assured were allowed to retain both sums, he would be paid twice over for the same loss. He would be more than indemnified for the loss. Summing up, the simple principle is that the insurer cannot recover under the doctrine of subrogation now embodied in Section 79 of the Marine Insurance Act 1906, anything more than he has paid. Gifts and voluntary payments. Whether an insurer who has paid the assured and has thereby been subrogated to the rights of the assured is entitled to claim any benefit which has been conferred on the assured by third parties is a question which has to be considered. The real issue here is, how far does the principle of subrogation extend? An assured may receive gifts and voluntary payments made by third parties for the purpose of compensating him for his loss. This precise point arose in Burnin versus Rotokanachi, where a compensation was paid to the assured in respect of the difference between the real value of the cargo and the sum which the assured received from their insurers. The insurers claimed from the assured as salvage this sum which the assured had received from the compensation fund. The House of Lords held that the insurers were not entitled to this sum because it was a gift made not for the purpose of reducing the loss against which the insurers had to indemnify the assured, but to compensate the assured personally for the loss actually sustained by him. In each case, the purpose of the gift or voluntary payment has to be ascertained. An insurer cannot claim a gift or payment the purpose of which is to indemnify the assured for that portion of the loss which the insurance had not covered. Under insurance, an assured may insure for an amount less than the insurable value, or in the case of a valued policy, for an amount less than the policy valuation. In such an event, he is underinsured and is deemed by Section 81 to be his own insurer in respect of the uninsured balance. An assured who is underinsured may find himself out of pocket, even though he may have been fully indemnified by the insurer under the policy. As he is his own insurer for a proportion of the loss, he is entitled consequent to abandonment to a proportionate share of the salvage. The doctrine of subrogation, which originates from the principle of indemnity, will not permit an insurer from recovering more than he has paid out for his share of the risk. This principle was applied in the Commonwealth, where the Court of Appeal held that the underwriters are to take all that is recovered, provided it does not exceed the amount they have paid. Settlement of partial loss. As there is no question of abandonment of the insured property in the case of an indemnity for a partial loss, the insurer has no proprietary right to the subject matter or the remains of it insured. By Section 79(2), he is subrogated only to the rights and remedies of the assured, but only insofar as the assured has been indemnified. On the other side of the coin, the assured would not be allowed to retain any recovery from a third party when he has already been indemnified by his insurers. End of Part 1. Maritime Academy